I decided my virtual background, it was acting weird. Like the green screen was doing really weird. It's the exact same thing that's behind me, except it's just a better picture of it. It's lit up better. Well, never mind. Just move the green screen. Just let it be the virtual background. So same thing. How is everybody tonight? We all here? 1, 2, 3, 4, 5, 6, 7, 8. We missing one? One, 2, 3, 4, 5, 6. We're missing one. We'll give it a minute. It's only 6:01. Have any of y'all gotten any bad weather yet? Me neither. They're saying here, I mean, it kind of, the porch was wet, but I went to put the garbage out because tomorrow's garbage day and it wasn't anything. But they're saying that, I think Germantown Baptist, the church down the street, canceled everything tonight. And they've canceled all vaccine appointments for tomorrow. So they must be expecting something. Stay home, stay safe. What can I say? I went to the grocery yesterday. I'm good to go. Okay. Here's what we're going to do. We're going to do Pacific Grove Spice first. Do your presentation. Let's do that one. I want to talk a little bit about Tire City now that I've looked at everybody's. I'll talk about Chestnut Foods, which you turned in tonight, and then I'm going to lecture on capital structure. You'll just love it. Okay, who's doing the presentation tonight? I'm not seeing it.
Heather and I are going to do it.
Has Stephen? Oh, he's here. There he is. He's rejoined us. Good. Okay.
Yeah, I'm here. I'm driving home right now. I'm almost there.
Almost there. Okay.
Yeah.
Okay. You want to go ahead? Share your screen. Let's go for it.
Hey, can you hear me okay? Okay.
Yeah, I can hear you.
Okay, Pacific Grove Spice Company. Okay, a little bit of history about it. It got its start in California in the 1980s. It's grown and it's the place to go buy spices. Let's see. Sorry, I can't. Let's move that over. Okay, they have a good reputation. Sales, 90% of sales were made to high-end grocery stores. The other 10% were online sales. Okay, so let's see. So what they have going on right now, Pacific Bank wants the company to reduce its dependence on debt. So they need to have a interest-bearing debt to assets less than 55%. And the equity multiplier less than 2.7 by next year. So Pacific has offered, it's been offered a few opportunities, a cable cooking show that they can join with and produce. They also have the offer of issuing 400,000 shares at $27.50 per share. And then they also have opportunity to acquire another spice company, High Country Spices. And so they want to see their options and see what's the best fit for their company. Okay, so if and how can Pacific take advantage of these opportunities that come to compliance with the bank's constraints? So they need to know if they can justify and finance the TV program or acquire High Country, or can they finance both and sell issues and issue new stock? All right. So this one, based on Pacific Grove's forecasted financial statements, is it profitable to bring it in compliance with banks at its current state? So it's showing with the ratios of the current situation on the balance sheet. Although the growth in sales are expected to increase 15% from this year to next year, Pacific Grove will not be in compliance with the bank's requirements. The future expected debt to total assets looks to decrease by just a little bit, but not enough for the bank standards by next year. The equity multiplier is also decreasing over the next few years, but not quick enough either. The forecasted tie for the company is expected to improve 12% in 2012. So that's a steady increase over the next few years, which shows its position on repaying debt to be less of a risk. All right. Should Pacific Grove sponsor the television program? And how would they invest this? Okay, according to the 41.28 IRR on the television program, it's an excellent opportunity and investment, but they would need to find funding for this project, which is kind of the opposite of what they're going for, because they're needing to borrow money to go towards sales growth rather than a new project. It would drive up 80% borrowing allowance, well, from the current 81%, but it wouldn't benefit their debt situation at all. Using internal strategies wouldn't quite get it, like reducing accounts receivable or increasing accounts payable, or reducing inventory. But issuing new stock would be an option to make this possible. Overall, taking the project probably wouldn't be a good idea at this time for the company. All right, so should they issue new common stock to the new investment group? All right, here's the ratios for the new before and after the new stock issuance. In 2011, which is their current equity multiplier, is 3.47. Debt to assets is 62.35%. This would actually lower the equity multiplier within the bank's requirements, as well as the debt to assets. So they would be in compliance to be able to borrow more money. But it would have a negative effect on their current shareholders and their share prices. It would probably lower the share price, and the market, they said, was really volatile right now. So it would probably have a negative effect and make them not look so attractive. So the ownership and distribution of shares, the founders and the CEO, they currently own like 25% and 7%, and the other investors 68%. Well, with the new investment company coming in, it would cause share dilution, and they would have a less percentage of ownership of the stock. Where am I? Okay, so issuing the new common stock. They have an option to issue new stock, but and it would put them in compliance with the bank. But the option would allow PG more borrowing power to fund its growing business, but this plan will drive the share price down, and it might cause them to appear less attractive, and with the share dilution. Although this plan is not currently maximize shareholder value, they may have to sacrifice a little bit for the better good of the company. So it is a good idea to issue the new stock.
Okay. All right, I'll pick up here. I'll talk a little bit about High Country Seasonings. So we want to know if Pacific should acquire High Country Seasonings. Just a little bit about High Country Seasonings. They're a privately held firm founded by two sisters. They offer a product line that would add to Pacific Grove's extension, or there'd be an extension of Pacific Grove's product lines. They're in negotiation to sell the company at $13.2 million, which is 16 times High Country's net income in 2011. The owners are only going to accept a common stock transaction, which equals 404,908 shares of Pacific, valued at $32.60 per share. If the investment's net present value is greater than $13.2 million through an analysis of free cash flows, Pacific will accept the offer and purchase High Country Seasonings. You can move on. All right, is High Country a good investment? So we discounted the expected free cash flows from the acquisition, and From what it indicated, the acquisition cost of $13.2 million is more than covered. So we've got 71 million, what is that? 71,000,020 at 5.85%, and at 5.51%, we've got 170 million. All right, is High Country a good financing investment? The acquisition of High Country would bring Pacific Grove into compliance with the bank's constraints. Interest-bearing debt assets would be reduced to 52%. The equity multiplier would reduce to 2.6%, and Pacific would be at a borrowing rate of 72%. Can the acquisition finance the TV program investment? From what we found by combining the statements together, we found that High Country does support the financing of the TV program without having to go outside. Does the acquisition of High Country solve Pacific's financial problem and allow Pacific to invest in the TV program? Yes, it will bring them into compliance with the bank and allow them to invest in the TV program as well. And that's it.
Unmute. Nicely done. Okay, group 2, do you have any comments, questions about it? Hey, Stephen, you're home. I thought this was an interesting case to include for several reasons. First off, it wouldn't be uncommon for a smaller company to be presented with several opportunities all at once, like they were. But on one side, they're challenged. Their bank is pressuring them on some of their ratios. Not uncommon. As they got bigger, they had to add debt. But here they've got this chance to buy a company that's a great fit for them, and they've got a chance to sponsor a TV program that would drive up sales. Wow, how can they do all of that? Well, you got the answer exactly right. Because High Country didn't have a lot of debt, putting those two together brought them in compliance and then gave them the opportunity to do the TV show. So while it looks like individually you couldn't do it, when you put it all together, you can. So I thought that made a kind of a neat case to look at. Comments from anybody? I see you're all muted up there. Group 2, Chera, all of y'all.
I'll say something. It was a lot of work.
Yeah.
There was a lot of effort that went into that one. It was big.
Yeah, this one had a lot of stuff going on and combining the balance sheets and all the different stuff.
Mm-hmm.
But I kind of thought it made a neat point when it got all together. Because when you first look at it, you think, oh, no, they can't do all of that. I mean, no.
Right.
Because right off you see, my gosh, they can't get their equity multiplier even close. I mean, they're not. And that was the drive behind all of it. But then when you put it all together, yeah, they can. Nice job, ladies. And Stephen, I assume you were in on that. Okay, let me talk about, I'm going to talk about Tire City. Chera, did you want to say something?
I was just going to say, I totally agree with Heather that was a ton of work. And at first I definitely thought that, I mean, you wouldn't think that since they're all individually bad, investments together, it would work out that way. But it was interesting to see that it did, but it took a while to get there.
Yeah, it did. Yes, it did. This was not an easy one. But like I say, I liked it for the reason that when you look at each thing, it seems like, but that would be something that a smaller company could be faced with. Pressure from their lender, plus some opportunities that would be really good. How do we make this happen? And in this case, it could happen. They could actually do it. So that was what I liked about it. I know. See, I have a point for picking these things. I don't just pick them out of the sky. Okay. I want to share something. Share my screen. I want Tire City. That's what I want to share. I want to talk about Tire City. Now that I've looked at them, I want to comment a little bit on it. Why am I not moving over here? Okay. This one is the one that is using, let me go back. Well, I'm going to do the one that's using 1995 as the basis because I wanted to comment on where I saw some issues in it. Usually up here on depreciation, it didn't change in 96 It only changed in 97. When they say 10% of long-term and bank debt, that includes down here, current maturities of long-term debt, bank debt, which they didn't have any in 95, and their long-term debt down here, wherever it is. There it is, 750. It's the long-term debt at the end of the previous year. That's where those numbers are coming from. Okay. Moving on down. This is where we're looking at the inventories reducing and then going back where we were. Gross plant and equipment and depreciation are not a percent of sales. Gross plant and equipment, we added the 2 million in 96 and the other 400,000 in 97. And this added on depreciation from the previous year, from the year. Bank debt was the plug in both cases. And of course, retained earnings is not a percent of sales. Common stock is not a percent of sales. That stayed constant. Long-term debt went down by the current maturity. So that's how that stayed, kept going. So I kind of wanted to comment on that because there's one, we have a test coming up. And I could talk about that for a minute so you kind of know what it's going to look like. There's two parts to the test. There's what would, if we were in normal class, there would be a take-home part and an in-class part. The take-home part is on Sunday before the in-class part, which you'll be doing during your normal class period. Now, here's the logic that goes with that. There you go. The take-home part has got a few short answer questions and ratios because ratios are easy. I mean, they really are. I mean, just straight ratios are easy. But we studied them, so I feel like I need to test on them, but it's not worth taking up class time to test on it. Not in this environment, not in a class time environment. So the in-class part will cover the other things, the AFN and the percent of sales thing, weighted average cost of capital, where you've got the comparables and you find the cost of capital. And then there will be a capital structure, which is what I'm going to lecture on tonight. So that kind of gives you a preview. Okay, let me pull up. I'm not going to talk a lot about chestnut, except I will show it to you because I'm going to wait and talk about it next week after I've looked at y'all's. Here's the bottom line. As you might imagine, the food products lady was right. Yeah, you could kind of read it in the tone. The instruments guy wanted to hang on to the hurdle rate, the constant hurdle rate, because it was to his best interest to do that. The food products lady wanted the risk adjusted because it was in her best interest. But in actual fact, risk adjusted is the right way to go. And you can see that here's the final result from the solution. Under food products, their cost of capital is 5.6, but they're actually earning 6.3. Instruments, cost of capital is over 9, but they're only earning 7. So Van Muir trying to buy in and saying he didn't think we ought to, go in, put more money into instruments. He was correct. But I will talk more about that next week and show you. But this is out there. This is posted out there. Okay. Let me get rid of that one. Stop my share. Okay. I am going to talk about capital structure, which is our last topic before. I don't want that. I want. Go away. I want to share my screen. Where's PowerPoint? That isn't the one I want. Show all windows. That's the one I want right there. Capital structure. I'm sorry to tell you that this is relatively long, but I talk fast, so you can trust me to get through it. And there's nothing, I don't believe there's anything in here you hadn't seen before, because most of this lecture comes from 338. Okay, background and theory. That's the first part. Then we're going to look at some examples. We're going to look at the overview, business versus financial risk, and the theory and evidence. And then we're going to look at the examples in kind of part 2. That's the part you need to focus on as to what's going to be on the test right there. Okay. Our basic definitions. V is the value of the firm. FCF is free cash flow, weighted average cost of capital, cost of stock and cost of debt, and the percentages of stock and debt. Now, The value of the firm is the discounted value of its future cash flows, discounted at the weighted average cost of capital. So those are the two things that drive the value of the firm right there. What's their discount rate and what kind of free cash flow are they going to generate? Now, debt, let's look at the cost of capital. Debt increases the cost of equity because debt holders have a prior claim. So the risk of adding more debt is focused on the shareholders who have a residual claim. But it reduces the firm's taxes because they can deduct the interest, frees up more cash, and it reduces the after-tax cost of debt. But it increases the risk of bankruptcy. Now, when you add more debt, it increases the cost of debt and it increases the cost of equity. There you go. Because you have more debt, more of your company financed with lower cost debt, less with high cost equity, it's kind of uncertain how that's going to play out. But adding more debt increases the probability of bankruptcy. You have direct cost of bankruptcy, the legal fees involved, the fire sale of any inventory, and you have indirect cost, reduction in productivity, line workers, people get scared for their jobs, reduction in credit. You may have trouble, you may be put on a cash on delivery basis. Those indirect costs reduce productivity. Customers choose other sources, especially if what you offer is a product or service that requires ongoing maintenance. They're not going to want to buy it from you. Employees not only worry about their jobs, they leave. Trust me, I worked for a company that went bankrupt. I was there. People leave. Suppliers tighten up on credit, which is going to raise your working capital. Profit's going to go down. Free cash flow is going to go down. Now, what about managerial behavior? More debt actually reduces agency cost because debt reduces free cash flow. You don't have the money to do stuff, but it increases them. On the other side, there's an underinvestment potential, and we'll look at it. Asymmetric information. This is a fancy term we use in finance that means insiders know more than outsiders. Managers know better than outsiders, investors, how the company's doing. What that means is managers not going to issue stock if they think the current stock price is too low. Investors know that. So they perceive the issuance of additional stock by a company that already has stock trading as a negative signal. It drives the stock price down. Now, business risk. Business risk is just the basic business, uncertainty about the future returns. It depends on everything. Financial risk is the added risk that is concentrated on the stockholders when they use debt, when the company uses debt. There you go. Low risk, high risk, you know that. Now, what influences business risk? Just the demand variability, sales price, input cost, ability to develop new products, just all the stuff that's involved in a company. There's two of them here. The ability to adjust output prices for changes in input costs. This is the one where Warren Buffett said, if you have to have a prayer meeting to raise your prices by 10%, you're in the wrong business. The one we want to look at is degree of operating leverage. Coming right up. It's the change in EBIT caused by a change in the quantity. The more fixed cost you have, the more operating leverage you have. The higher proportion, the greater the operating leverage. Now, look at capital structure theory. This is a big one. Modiani and Miller. It's called M&M 58. It is so fundamental. It is so much the seminal work in this area. I can assure you nobody in academic and finance cannot talk in depth about that because it is so basic. And what's so interesting about it is that prior to 1958, there was no theory related to capital structure at all. So they were the first. They have a second one, 63, Modiani and Miller again, Franco Modiani and Merton Miller, 63, and then Miller, 77. We're going to look at trade-off theory, signaling theory, pecking order, managerial constraint, and windows of opportunity. There. This is M&M 58. If two portfolios produce the same cash flows, then they must have the same value. The implication, a firm's value is unaffected by its capital structure. It doesn't matter how much debt or equity they have. Now, here were their assumptions. No brokerage costs. We always assume those away because they're different. No taxes. These are strong ones. No bankruptcy cost. Investors can borrow and lend at the same rate as corporations. That's not true. All investors have the same information. That's not true. And EBIT is not affected by the use of debt. Let me say something about, because those are pretty strong assumptions, and we're actually going to relax both of those coming up. The role of assumptions in the development of theory, because those are extremely strong assumptions. And when you look at them, you think, well, I mean, obviously, we all have taxes. Investors can't borrow and lend at the same rate. I mean, we can lend because we can lend money to a corporation by buying a bond, but we can't borrow at the same good rates that they can. The role of assumptions in the development of theory is kind of like getting all the little loose chaff away from everything. Just get everything out of the way and focus on the basic thing you're trying to prove, the basic theory. And then you go back and start relaxing the assumptions and see if it holds. Okay. Firm U, they're unlevered. Firm L is levered. You can look at them. Firm U has no debt, so they have no interest. Firm L has interest. Cash flows to the shareholders, cash flows to the debt holders. Total cash flows to investors, exactly identical. If the total cash flows are identical, then the value of the firms are identical. Capital structure is irrelevant. Now, going forward, we know that's not true. But this is assuming zero taxes, zero cost to bankruptcy. And let me say this in their defense on that one, on the bankruptcy. They were basing that on some work by a man named Warner, who studied bankruptcy in railroads and concluded that the cost as a percentage of the cost of the value of the firm was extremely low. Well, it's probably true, except for a little fact. Railroads do not come under the same bankruptcy laws as corporations. They have a different set. And at that time, they were regulated by the Interstate Commerce Commission, the ICC, who took over a lot of the work for them. So in truth, yes, their cost was extremely low. Okay, let's jump to 63. This is Modiani and Miller again. They relaxed the assumption of no corporate taxes, so interest can be deducted. Debt shields some of the firm's cash flow. So here's how it works. Now the value of a levered firm is the value of the identical unlevered firm plus the tax shield. The taxes at that time is 40%. Then every dollar of debt adds 40 cents of extra value to the firm. It's pretty strong. There's what it looks like. So basically, under this, with corporate tax, the value increases continuously as more debt is added. It just keeps going. Now, look at this. As you add debt, they're saying debt stays where it is. The value of the cost of equity goes up, so the cost of capital goes down. Implication, 100% debt is optimal. That was 63. Again, by now, we know that's not true. Miller in 77, and this was not in a paper, this was a keynote address at the American Finance Association. He introduced personal taxes. They lessened the advantage of corporate debt. Corporate tax favors debt financing because interest is deductible, but personal tax favors equity financing because you don't have to pay tax until the stock is sold and long-term gains are at a lower rate. So, new formula. corporate, personal on debt, personal on stock. His result from this was value rate does rise with debt, but only by about 25%. Now, in our latest changes with taxes, this would bring it down even lower. Okay, we got some other theories. M&M theory assumes no cost to bankruptcy. That's not true. The probability of bankruptcy increases as you add more debt. At low levels of debt, the tax benefits outweighs any danger. When you get high enough debt, then you've got the potential of bankruptcy and you've got some problems coming. Theoretically, this is strictly theory, there is an optimal capital structure that balances those benefits. That's what it looks like. That's the threshold where bankruptcy begins, the cost of it begins to be material. There's your optimal level right there. And after that, it's downhill. Now, that's one theory. And we're going to look at some numbers for all this. Signaling. M&M assumed that investors and managers have the same information. We just said asymmetric information. That's not true. Managers know more than investors. They often have better information. They'll sell stock if the stock's overvalued. They'll sell bonds if it's undervalued. Investors know this, so they view new stock sales. That's a negative signal. Pecking order. This one is not empirically supported, but intuitively it makes sense. Think about it. You're the firm. You want to invest in something. You need money. Where's the first place you're going to get it? Retained earnings. There's no flotation cost. There's no negative signal. Until the annual meeting comes up in the annual report, you don't have to even tell anybody what you did with it. That's your first choice. Second choice, debt. Flotation cost is a lot lower. Not only is it not a negative signal, it's actually a positive signal. Doesn't dilute ownership. Final choice, equity. So when a firm who already has equity trading issues more equity, it's a signal that they've run out of all of this. They don't have any more retained earnings internally. They can't issue any more debt. There's no interest rate at which the market will take it. So they're down to wanting equity. It's a negative signal. And as a description, what happens is the stock price declines. Let me back up and say something else on that for a moment because we don't get it right in here. When the market reacts to news, the news that a company is going to issue seasoned equity, that brings this price down. So say the company it's going to issue 100,000 shares and the stock's currently trading at $20. They announce that they're going to issue these new shares. The price may drop to 18 because it's a negative signal. So now they've got to issue more shares to get the money that they want because the market reacts to the announcement of the issuance, not the actual issuance. Okay, agency problems. Well, managers use corporate funds for things that just aren't good for the company. If you have debt, it commits free cash flow. It forces a discipline on managers. As it says right there on the bottom line, an LBO, a leverage buyout, is the ultimate debt controlling event. I've been with a company that had an LBO. I can assure you the focus at all time was having enough cash to make the debt payments. That was the focus. The other side of the agency problem, we talked about it earlier, underinvestment. Because debt increases financial risk, managers may avoid a risky project that would have been good because they're so scared of failure. Now, think about our little graph. They should stay below less than optimal because they need to leave reserve borrowing power, particularly if they have investment opportunities. If equity issue is costly, there's some other things that they should. This is just like your credit card. Say your credit limit is $2,000, but you shouldn't run it up to $2,000 because you need to have some reserve in there in case you need new tires. I mean, you don't want to use just all of it that you can. And windows of opportunity. Managers try to time the market. They'll issue equity when the market is high and stock prices are high. They'll issue debt when the market is low and interest rates are low. Oops, I forgot I got little arrows on this one. I just remembered. When the term structure is upward sloping, they'll issue short-term debt, hoping it'll come down. If the structure is flat, they're going to go for long-term debt. Try to lock in that lower rate. Now, here comes the evidence. The tax benefits are important. $1 of debt does add about 10 cents to the value of a firm. So that supports the Miller model with personal tax. Bankruptcy is costly. It can run anywhere to 10 to 20% of the value of the firm. After the stock price runs up and the debt ratio goes down, firms tend to issue equity anyway. So that's inconsistent with trade-off. It's inconsistent with pecking order. It's consistent with the windows of opportunity. Firms do tend to maintain excess borrowing capacity, just like we do, like I say. Firms with growth opportunities, with asymmetric information problems. Managers should take advantage of the tax benefits, especially if they're in a high tax rate, if their sales are fairly stable, and they don't have a lot of operating leverage. They should be careful if their sales are volatile. And look at the end, special purpose assets. If you've got equipment that can be easily put up as collateral or easily sold, that's different than having assets that have been specially constructed just for you that are going to be difficult. Now, if the manager has information, then they should avoid equity if the market price doesn't really reflect how well the firm's doing. And finally, they have to consider how this is going to affect their lenders. Affect their ratios, we just saw with Pacific Grove, and how their rating agency, how that's going to look at it. And with that, let's take 5 so I can get something to drink here. And then we're going to go through the examples. Okay? Stop the share and I will. Let's record again. Okay, let me go back where I was. Come on. There we go. Share that again. Well, how come I'm not back where I was? I don't want to be there. I want to go down to the examples, because the examples is where you need to be. Boom, 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 boom. Here we go. Okay. This is the kind of thing that's going to be on a test. Okay. And this does come from a previous 338. Strasburger Electronics. They're going to have to choose between 2 projects. And then we're going to look at adding debt to their capital structure and what that does to their ROE and risk. We're going to look at choosing the optimal capital structure and performing a recapitalization. So here's the data. They got 2 choices. Plan A, low fixed cost, $20,000, but a higher variable cost, or high variable cost, higher fixed cost and lower variable. Otherwise, everything's the same. Now, this applies to both of them. There's the probability distribution. They think they can sell 100,000 units each year for $2 a unit. Standard deviation, coefficient of variation. We all know how to do that. Okay, here's plan A. Operating cost, $170,000 pre-tax, right? $200,000 income, $100,000 EBIT's $30,000. After tax, return on invested capital. There it is, 9%. Plan B, 12%. Now, let's talk about break-even quantity. Break-even quantity is the fixed cost divided by, there it is, the difference between the selling price per unit, P, and the variable cost per unit, V. Here's the logic of this. And I actually dealt with this at a company I worked for a long time to try to explain to them about contribution to fixed expense. Anything you sell, service, product, whatever, it's got to cover the cost to do it. P has got to cover V. it's got to cover the cost of actually producing it. Anything above that is a contribution to fixed expense, which is there no matter what. That's the logic of that. For them, the break-even quantity for A is 40,000 units because, yeah, see, break-even for B is 60,000. Now, that's what it looks like if you graph it. Low operating leverage, higher operating leverage. We just talked about it. Okay, now we're going to talk about them adding debt. Right now, Strasbourg doesn't have any debt. They're going to go with plan B, high fixed cost, low variable. They got two choices. They can stay at a zero debt, or they can move to 100,000 debt and be 50-50. And the cost of that will be 10%. Cost of that debt will be 10%. Okay? EBIT stays the same right now, no debt. There they are, there's their ROE. If they add debt, now they've got interest, taxes at 40%. Their ROE goes to 18. Remember how we talked about adding debt drives the ROE up? There it is. Now, here's how that happens. ROE goes up. I think nope, I didn't either. Whoop, back. ROE goes up, standard deviation goes up, it doubles. Because think about it, they've gone 50-50. The value of the firm was 200,000, they've now gone 50-50. Coefficient of variation goes up, net income goes down. But dollars to investors goes up. Because with no debt, the whole 24,000 belonged to the investors. No debt, it all went to the shareholders. At 50%, 10,000 went to, 18,000 went to shareholders, 10,000 went to debt holders, total 28,000. So actually, to investors, it went up. Now, there's the explanation of that. They also paid less tax because they got to deduct the interest on the debt. The stockholders are bearing the risk. Without debt, the standard deviation of ROE was 14.8. With 50% debt, it's 29.6. That's exactly double. The difference is their financial risk. Okay, let's talk about optimal capital structure. Optimal capital structure maximizes shareholder wealth. That means it maximizes the stock price. It maximizes firm value. It maximizes the stock price. Those two are actually pretty much the same thing. It minimizes the cost of capital. It does not maximize earnings per share. And we're going to see all of that. So here's the steps. Estimate the interest rate the firm will pay. And we're going to look at it, and you would have it on a problem where, like, if you have 10% debt, it'll be the cost, 20% this, blah, blah. Estimate the cost of equity. Estimate a cost of capital. Estimate the free cash flows, get the value of the firm, deduct the value of debt to maximize shareholder wealth. Okay, that's our first part. They're currently all equity. EBIT is 40,000, 10,000 shares outstanding. Cost of equity, 12%, which is also their cost of capital because they don't have any debt. And if you look at it, beta's 1, risk-free rate 6, market risk premium is 6, so 6 plus 6 times 1 is 12. Tax rate's 40. Cost per price per share, 25. Okay, here's the debt schedule. Since they don't have any debt, they probably went to their banker and said, if we go from 0 to say 40%, what's going to be the cost of debt? And they're going to have given them a table, something like this to deal with. That's what they're looking at doing right there. Now, we've already looked at this some with the weighted average, when we were looking back at weighted average cost of capital. The cost of equity at different levels of debt. It's Hamada's equation. M&M theory says beta changes with leverage. Look, I don't know where that came from. The beta, remember when we looked at this in the extension of the cost of capital lecture? Beta unlevered is the asset beta. Beta levered takes into account the level of debt. Pay attention. That is not the percentage of debt. That is debt to equity. It's not debt to value. It's debt to equity. Okay. So for Strasbourg, using Hamada's equation, 1 plus 1 minus the tax rate divided by 50/50. So their beta is going to go from 1 to 1.6. Pretty hefty. That's going to drive their cost of equity from 12 to 15.6. Okay. Now, 40 is highlighted, and I just left it on here. But they were looking at doing 50% finance with debt, 50. And that's what it is. Optimal for them is 40. Look at it. That is the highest value of operations. That is the lowest cost of capital. That is where they need to be, is at 40. It maximizes the value of the firm. It minimizes the cost of money. So here's kind of what it looks like. This is on equity. This is the risk-free rate. That's the business risk. This is the financial risk. So as they add debt, that cost of equity goes up. Now, the cost of debt. Cost of debt goes up as you add more. Cost of equity goes up, but the cost of capital can come down before it starts back up. That's your optimal level right there. That's what we just saw. Go back to the table. Look at the after-tax cost of debt. Goes up. That is the best spot for them, is 40. Now, corporate value. With debt equal to 0, we're assuming no investment in capital, 0. So free cash flow is just EBIT times 1 minus the tax rate. Cost of equity is the cost of capital. So the value of operations, $200,000. Easy enough. That 222, that's where we go, from 200 to 2222. Now, the implication, look back at it. The implication, they should recapitalize. In other words, they should issue debt up to 40% to get their value of the firm up to here. Here's how they're going to do it. You issue the debt and you use the funds to repurchase equity. Optimal debt's 40%, cost of money 10.8. It's going to maximize value. Here's how it's going to work. This is before they do anything. This is where they are right now. Before the repurchase, the cost of capital decreases to 10.8. The value of operations increases. They borrowed the money, 88,889, and they've stored it in short-term investments until they can repurchase. And they've got that much in debt. So here's what that looks like over here. Short-term investments, there's their debt. They borrowed it, but they parked it in short-term investments. Right there, value of operations has already gone up. There's their debt. Stock price has already gone up. The stock price reacted to the debt. Now, shareholder wealth went up. It's the announcement that sends a signal that affects the stock price. The repurchase itself has no impact. If investors think the repurchase is good, going to drive up the price, then they'll purchase the stock now and drive it up. They think it is, they'll short it or sell it, which will drive it down, of course. Now, how many shares are going to be left after the repurchase? Well, D0 is the original amount of debt, which is 0. D1 is the amount after issuing new debt. If all new debt is used to repurchase, which it is, 88,889. Number of shares, N0 is before 10,000, N1 is after. Well, it's the 10,000 minus 88,889 divided by 2222. Afterward, they're going to have 6,000 shares. And that's what it looks like. They don't have any money in short-term investments anymore. They used it to repurchase shares. They still have the debt. They're now down to 6,000 shares, and the stock price per share has stayed the same. That's how a repo works. Short-term investments used to repurchase. Stock price didn't change. The value of the stock falls because they don't have the short-term money anymore, but the wealth of the shareholders remains the same. Now, let's look at earnings per share over here. Earnings per share continues to go up. Capital structure that maximizes the firm, the value of the firm, doesn't maximize earnings per share. It keeps right on going. We're at 40%. That was the one. That's the maximum right there. This is the value of the firm. This is earnings per share down here. It just keeps on rising. And there it is. That's our optimal spot right there. We want to find that place where it makes that turn. And if you look back, let me go back to the table. Don't even make you too dizzy while I do this. There. Notice the value of the firm goes up, 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 that to there, and then starts going back down again. That's what that table is looking at. Just close your eyes while I zip through all this. That's what it's saying. It goes up and then comes back down. Okay. Optimal capital structure. It's 40%. It gives them the highest corporate value, the lowest cost of capital, the highest stock price per share. It does not maximize earnings per share. Now, and I'll stop sharing. Did that look familiar? Nodding heads. Come on, nodding heads. That came out of your 338 textbook a few years ago. Okay. The part you certainly need to focus on the theory. I mean, because you're supposed to understand the theory. The part that's likely to be on a test is the finding the optimal capital structure and doing the recap. Understanding how that works. So that's the part I want you to focus on. Questions about it? Y'all are all so quiet tonight. Yeah, I see you smiling out there. See, if I had you in class, I could get you to talk. Questions about anything? I don't have anything else I'm going to talk about tonight. Unless we have some questions.
You don't, I know like on previous tests, you had like conceptual multiple choice. Is there anything like that on this one?
No.
Not because it was all in Excel. I was just curious.
No. The Blackboard test are, but this is using that method called file response. You'll sign in and it'll open on Sunday. We'll talk about it, right before the test. It's an Excel spreadsheet. You download it, complete it, and upload it. So it's more like the individual case assignments, more like that. Yeah. Except in this case, it's got tabs. It'll have like the first one has got some short answers that you just fill them in right there. And then it's got some ratios. And then the other part is going to have AFN and the percentage of sales. That's on one tab. Weighted average cost of capital, where you've got comparables. You don't have to pick them. I'm telling you, there they are. You just need to be able to do the calculations. There's not much. There's nothing about deciding what's the risk-free rate or deciding which one's a comparable. The test is strictly, can you perform the calculation? Can you follow the methodology and do the calculation? Does that make sense?
Yes, ma'am. And
Yeah.
we'll, you said we can you'll provide a formula sheet?
Yeah, I'm thinking, I gotta go look at it. Yeah, I will, if you need one. I'm thinking in some of the cases, the formulas are right there. I mean, like on the template, the AFN formula is right there, I'm thinking. I'll look and be sure. But yeah, if you need a formula sheet, I will definitely provide it. No question about that.
Cool.
So you'll have both of the parts, the Sunday part and the Wednesday part are both 3 hours, but the Sunday part, you can do it anytime during the day. It's like I say, I feel like if we covered ratios, I should test you on it, but it's not worth taking the 3 hours of class time to do that. I don't feel like that when we're live either. I do exactly the same thing. And a couple of little short answers won't hurt you. It shouldn't take you 3 hours. It should take you about 40 minutes, maybe, on a good day. So then you can focus the in-class part on AFN and percent of sales. And this one doesn't have anything funny about it. It's just that there's the balance sheets, there's the projection, do it, and the formula. The weighted average cost of capital, it's got like 3 comparables, I think, that you unlever, relever. It gives you the risk-free rate. It gives you, you know, all of that to find the cost of capital. And then the third part, it looks like what we just did here with Strasbourg, finding their optimal capital structure and doing the recap.
So it kind of, from what it sounds like the test will probably be more easier or simpler than the cases.
It actually is. To me, it is.
Yeah.
Because the cases don't tell you everything. I mean, you know, you have to figure it out. Like, oh gosh, how do I put all this together? Because like I say, the cases are meant to make you think.
Sure.
Like you would in real life, where they don't tell you everything. For me, the test is meant to be sure you can execute the methodology. That, okay, I've decided I need to find comparables and do this and figure out the cost of capital. Okay, can I do it? Yeah. So.
And when you say the at-home part opens on Sunday, you're talking about the Sunday before that Wednesday when we have the test in like 2 or 3 weeks.
Yeah.
Gotcha.
Yeah.
Okay.
And that's how I've done it when we were live. And I thought about doing it differently. I thought, no, just do it the same way. Just do the same thing. That's how I always did. In fact, both tests and the final have all got a take-home part. For the exact same reason. That it's something that I feel like I should cover on a test, but I don't want to take up your 3-hour class test time on it. Mm-hmm.
So they work the same, or is like what am I trying to say? They're all one test or whatever. I'm trying to see how much percentage of the test is at home and how much is.
I think on this first one, it's 14 points on the at home and 86 on the in class. And the next one, I can't remember. The split is not the same.
Gotcha.
The split is different on each one. It depends on what I made, how much of it I made at home and how much of it I made in class. It's not a lot at home. It's just enough to get those things out of the way. So you can focus on these 3 methodologies that you need to be able to know how to do. You need to be able to know how to do percent of sales. That's pretty fundamental, forecast a balance sheet. You need to understand how to do the levering and the unlevering and that thing. You need to understand this that we just went over on how to find the optimal capital structure and how to do the recap. And it looks just like that. Here we are. Here's where we do the borrow, and here's where we do the recap. That's what it looks like.
So when we do the review, as much as I'd love to say, or the ones we do, will they be just like that except different numbers? I know it probably won't be that way, but can we do an example or 2 of each when we do the review?
I'll try to come up with something. Yeah.
Just some, if you can. If not, I mean, please don't go out of your way. But just something, just kind of recap. Look, this is last semester. I want to pass everything.
You're gonna pass.
I know, but I just get a little worried at times.
You heard Adam. He was freaked out until halfway through.
Oh, we heard him. We heard him, that's for sure. He was talking.
I told him after, I said, I knew he'd talk that long, and I never did, because he was a talker. He was very entertaining to have as a student, let me just tell you.
I'm sure.
Oh, class was, because he would just blurt things out. But he was a very good student. And if any of you do want to talk to him about career opportunities, he will be happy to.
Sure.
He truly will. He is very generous about that. But I wanted you to see somebody who, he did fine, but he was just as kind of confused by the classes as you are, as some of you are. He was like, wow, this is so different. And he did fine. No, the cases are meant to make you think and see if you can, like you looked at Pacific Grove. Wow, first blush, they can't do this. Yeah, they can. When you put the numbers together, yeah, they can. But there's nothing like that on the test. Nothing nothing that involved. It's all on one little sheet. Each one is one little sheet. I think there's three tabs on the first one. AFN, WAC, and capital structure. I can tell you already, because I've already done it. Of course I have. Am I scaring you more? You got your head down.
Oh, no. I'm sorry.
No, that's okay.
I was looking at something. I'm sorry.
No.
No, I actually feel, when I first started the class, I was, like any other class, but I've settled in more now. So.
Good. It is very different. It's very different. I mean,
I also got to say I have really good group members as well. So
that helps.
That helps big time. Great group members.
Good. Because that.
Thank you. I appreciate that.
Yeah, I'm not a big fan of group work, as most of you probably are not. But in this case, the cases are such that it needs to be group work.
Sure.
Yeah, I mean, that's how it is. So, good. I'm glad you have a good group, because that does make a huge difference if you've got good people to work with.
Yes, ma'am.
Good deal. Any other questions? Anything? Chara has her hand up.
Is the portion that's going to be done Sunday, is that going to be on Proctorio, or do we just have to have it in by like midnight that night, or how does that?
It is remotely proctored with Proctorio, but it's going to be open all day, midnight to 11:59.
Okay, but we only have 3 hours to do that one
Yeah.
too.
You
Okay.
do not need 3 hours. Trust me on this.
Okay, good.
If I look on there and somebody took 3 hours, I'm going to think you took a nap while you were doing this. Good Lord. But I thought, well, I mean, I could make it an hour and you could probably do it, but whatever, 3 hours is fine,
I get less stressed if I have more time than I need
Yeah.
anyway, so.
So you have 3 hours. Trust me, you do not need it. When you see it, you'll go, huh? I needed 3 hours for this? I don't think so. I don't think so. No, you will not. But like I say, in each test, there's a few things that I just kind of think need to be tested on, but I don't want to take up part of the 3 hours on it. I want you to focus on the more important methodologies that I want to be sure you feel good about going forward. So this is how I'm doing it. Okay. Anybody else? Good case presentation tonight. I'm glad you all saw that in the end, that, yeah, you can do this. Nice work. Anything else? I will post the recording from tonight, and I will see you next week, and we will do American Home Products, which is interesting, and Philip Morris Craft, which is also interesting. I like our cases. I pick them because they're interesting. Yeah. Okay, y'all stay safe. If it does snow or ice or whatever on the earth is doing, stay safe. I'm staying in.